Welcome back, Yan Ag family. Let me get straight to it, because what's about to happen tomorrow morning could set the tone for the entire precious metals market for the next several weeks. On February 16th, the single biggest force in global gold and silver trading goes offline. Mainland China, the largest gold mining nation, the largest gold consumer, the largest gold importer, and the country responsible for the majority of refined silver output, shuts down for Lunar New Year and doesn't come back online until February 24th. That means 8 straight trading days without participation from the most important physical metals market on the planet. And this isn't just some routine holiday slowdown. This comes at a time when COMEX silver inventories are already stretched thin, delivery pressures are building, and volatility has already proven how violent it can get when liquidity disappears. Remember what happened just a few weeks ago. On January 30th, silver suffered the worst single-day collapse in its history, dropping roughly 35% in one brutal session. Gold had its sharpest daily fall since the 1980s. And while headlines blamed policy speculation and macro fears, the real culprit was much simpler. Liquidity vanished. Now we're about to go through 8 days where Asian liquidity doesn't just shrink, it practically disappears. So the real question is simple. Can this market function without China stepping in? Before we dive into the mechanics, quick note, most people watching still aren't subscribed. If you want daily breakdowns while we navigate this extremely unstable period leading up to March delivery, now's the time to lock in. This isn't normal market action. This is the kind of environment where either massive opportunity appears or accounts get wiped out. And I'm here to walk through it step by step, no sugarcoating. Now let's break down exactly what shuts down and why it matters. Tomorrow marks Lunar New Year's Eve in China. Mainland exchanges close, including the Shanghai Stock Exchange and the Shanghai Gold Exchange. Commodity trading across the country pauses. Hong Kong and Singapore only operate half days before shutting down. Then from February 17th onward, mainland markets remain completely closed through February 23rd. Hong Kong and Singapore also go dark for several sessions before gradually reopening later in the week. The result? For over a week, the physical center of the metals universe isn't participating in price discovery. And that matters because China isn't some secondary participant. It's the dominant force. China produces more gold than any country on Earth, more than Australia, Russia, and the United States combined. It imports enormous quantities of gold annually. Domestic households, jewelers, and investors buy more gold than any other nation. At the same time, China's central bank has now extended its gold buying streak to 15 consecutive months. January alone added tens of thousands of ounces to reserves. And this isn't speculation, it's strategy. China has been steadily reducing exposure to U.S. treasuries while increasing hard asset reserves. On the silver side, China refines the majority of the world's supply, much of it coming from base metal mining operations. And as of the start of this year, export restrictions tightened dramatically. Only very large producers are now allowed to export, removing hundreds of smaller refiners from global supply channels. In short, China is increasingly keeping metal at home. So when that country steps away from trading for over a week, liquidity conditions change dramatically. Here's why that becomes dangerous. Without Shanghai setting the tone, price discovery shifts almost entirely to London and New York, markets dominated by futures contracts and derivatives rather than direct physical buying. That creates fragile conditions. Spreads widen. Orders hit thinner books. Moves become exaggerated. In a deep market, a large sell order might move gold a few dollars. But in thin liquidity, that same order can trigger outsized price swings. Algorithms detect weakness, pile on momentum, stops trigger, margin calls cascade, and suddenly a manageable move turns into chaos. That's exactly what we witnessed in late January. Margin requirements were raised, leveraged traders were forced to exit positions, and selling accelerated during Asian hours when liquidity was already fading ahead of the holiday. By the time Western markets opened, the damage was done. Paper silver volume exploded, far exceeding actual global production, as positions were dumped and closed rapidly. Now imagine a similar setup, but stretched over 8 days instead of one session. If someone wants to push prices lower, this is ideal territory. But the opposite is also true. If physical buyers step in aggressively ahead of delivery deadlines, prices can spike just as violently upward because sellers simply aren't there. And we already saw how sensitive markets are last week when inflation data surprised traders. Silver jumped sharply in just a few hours because liquidity was already thinning heading into the weekend. So how do we navigate what's coming? Let's walk through the timeline traders need to watch. Tomorrow, February 16th, is essentially the last positioning window for Chinese traders before the shutdown. Early volatility will tell us whether domestic buyers are accumulating or reducing exposure going into the break. Watch Shanghai gold premiums relative to London pricing. Strong premiums suggest domestic demand remains high. Discounts signal selling pressure ahead of closure. Then from February 17th through February 23rd, liquidity becomes extremely thin. Any major news, central bank commentary, economic data, geopolitical surprises can create exaggerated reactions. Midweek, we get Federal Reserve meeting minutes. Normally, they cause modest moves. In thin conditions, reactions can be several times larger than usual. Then comes U.S. employment data later in the week. Weak numbers support rate cut expectations and could push metals sharply higher. Strong numbers do the opposite. Either way, thin liquidity means overshooting becomes likely. When Hong Kong reopens, traders will watch carefully to see if Asian participants validate Western price action or reject it. That feedback becomes crucial heading into the final days before China returns. Over the weekend, smart traders aren't resting. They're checking inventory reports, monitoring physical premiums, and watching how open interest shifts. Rising premiums mean physical demand remains strong. Falling premiums suggest supply is catching up. And all of this happens while COMEX inventories continue draining ahead of March delivery pressure. Which brings us to the second half of this story. Because while everyone is focused on the holiday shutdown, the real pressure point sits quietly in the background. And that pressure point is COMEX silver. Right now, registered inventory available for delivery sits a little above 100 million ounces. But open interest tied to March contracts represents several multiples of that amount. Everyday inventory continues to drain as metal leaves exchange vaults and moves into private hands. If this pace continues through the holiday window, by the time Chinese markets reopen, available supply could be noticeably thinner. And only a few trading sessions later, first notice day arrives, the moment when traders must either deliver metal or close or roll positions forward. If delivery demand remains moderate, the system functions. Stressful, but manageable. But if a larger number of participants decide they want actual metal instead of cash settlement, pressure increases quickly. Suddenly, vault stocks look small relative to obligations, and the market starts questioning whether supply is sufficient. And markets hate uncertainty. We already saw something interesting last month. One major bank handled nearly all deliveries, effectively managing distribution so the process didn't spiral out of control. But the question now becomes, can that balancing act continue if demand grows while supply tightens, and the largest physical buyer in the world has just been absent for 8 days? No one truly knows. And that uncertainty is exactly why this week carries so much risk. So let's lay out the possible paths forward. The first and most boring scenario, but also the most probable, is simple consolidation. Gold trades sideways, silver moves in a choppy range, volatility stays elevated but doesn't explode. Economic data comes in neutral, markets digest recent swings, and when China returns, prices continue drifting without major disruption. That's the calm outcome. The second scenario is a bullish breakout. Inflation cooling plus expectations for rate cuts fuel renewed buying. Physical buyers position ahead of delivery pressure, and thin liquidity allows prices to jump quickly. Momentum builds, Asia reopens supportive, and markets push higher into delivery week. The third scenario is the one traders fear, another liquidity shock. Someone unloads a large position during thin hours. Algorithms accelerate the move, stop losses cascade, and forced liquidations trigger. Prices slide sharply before stabilizing only after weak hands have been cleared out. Which one happens? Truthfully, nobody can predict that with certainty, and anyone claiming they can is guessing. That's why the smart move this week isn't prediction, it's survival. If you're holding physical metal, nothing changes. This is exactly the type of environment where emotional trading causes long-term investors to lose positions they later regret selling. Let volatility pass and reassess after markets normalize. If you're trading futures, risk management becomes everything. Smaller position sizes, wider stops, and avoiding overnight exposure unless you're comfortable with sudden swings becomes critical. Option strategies may offer safer exposure since risk is defined up front. For ETF or mining stock traders, remember liquidity still exists in US hours, but spreads widen and moves become exaggerated. Mining stocks especially can swing several percent on light volume alone. The biggest mistake right now would be trying to outsmart the market, attempting to front-run either a crash or a squeeze. Thin liquidity punishes overconfidence. The real advantage is preserving capital so you're positioned when normal liquidity returns and clearer trends emerge. Because step back for a moment and look at the bigger picture. Central banks globally continue adding gold reserves. Government debt keeps expanding. Real yields are declining. Industrial silver demand remains strong. Investment flows into metals funds have surged. Long-term structural forces still support precious metals. But short-term, liquidity rules everything. And for the next 8 trading days, the most important liquidity provider on Earth steps away. So this week becomes less about fundamentals and more about order flow. About who steps in to buy or sell when the market gets thin. My expectation? Likely a frustrating, range-bound environment with sharp moves in both directions, until China returns and real price discovery resumes. But I'm ready for either extreme. A sudden drop if liquidity cracks, or a rapid rally if physical demand overwhelms paper selling. That's what makes this period dangerous. So here's the final takeaway. Do your own research. Understand your exposure. Reduce unnecessary risk. Don't let hype or fear dictate decisions. Markets will still be here next week and next month. China comes back online February 24th. Delivery pressure peaks shortly after. That's when the real story unfolds. Until then, stay disciplined. Stay logical. Protect capital. And remember, the goal isn't to win every trade. The goal is to still be in the game when opportunity shows up. Trade smart. Khan AG out.